I lost money on my first investment. Not a little bit. Almost everything I put in. I was 22, fresh out of college, and I bought stock in a tech company because some guy on the internet said it was going to explode. It exploded all right. Straight into the ground. I watched $3,000 turn into $400 in 6 weeks. My grandfather didn't say, "I told you so." He just asked me one question. "Did you understand what that company actually does?" I didn't. I had no idea. I just knew the stock was going up and I wanted in. He nodded slowly and said, "That's not investing. That's gambling. And gamblers always lose eventually." That conversation changed everything. Because Jewish investment strategy isn't about finding the next big thing. It's about not losing. And when you build a strategy around not losing, the winning takes care of itself. Real quick before we get into this, drop a comment with your city. I want to see where everyone's watching from and what investment cultures exist in different places. Leave your city below. Here's the first principle that most investors completely miss. Preservation of capital matters more than growth of capital. Sounds backwards, right? Everyone's chasing returns. Everyone wants to double their money. Jewish investors ask a different question first. How do I make sure I don't lose what I have? This creates a completely different investment filter. Before looking at potential returns, you examine potential risks. Before getting excited about upside, you understand downside. Before asking, "How much can I make?" you ask, "How much can I lose, and can I afford that loss?" My cousin Sophie invests this way religiously. Last year, a friend pitched her on a cryptocurrency opportunity, promised incredible returns, could triple her money in months. She asked one question: "What's the realistic worst-case scenario?" The friend hemmed and hawed. Eventually admitted she could lose everything. Sophie passed. That cryptocurrency dropped 90% 3 months later. Her friend lost nearly everything. Sophie still has her capital. Did Sophie miss out on potential gains? Sure. But she also avoided certain losses. And over a lifetime of investing, avoiding losses compounds more powerfully than chasing gains. Because here's the math nobody talks about. If you lose 50% of your money, you need a 100% return just to break even. Losses hurt exponentially more than gains help. This is why Jewish investment strategy focuses so heavily on downside protection. You invest in things you understand. You diversify not for optimization but for survival. You avoid investments where you could lose everything, even if the upside looks incredible. You accept smaller gains in exchange for much smaller risks. Let's talk about understanding what you own, because this is absolutely critical. Jewish investors rarely buy something they can't explain to a 10-year-old. If you can't describe what the company does, how it makes money, and why people need it, you don't invest. Period. This eliminates most trendy investments immediately. Complicated financial instruments? Gone. Exotic derivatives? Nope. Hot tech stocks doing something incomprehensible? Pass. You stick with businesses that make sense. Companies that produce products people actually need. Industries that have existed for decades and will exist for decades more. My friend Isaac invests almost exclusively in boring companies. Waste management, utilities, consumer staples, food production. His portfolio returns are steady but unexciting. He's never going to brag about a stock that went up 300% in a month. But he's also never panicking about a stock that dropped 80% overnight. Over 20 years, his boring strategy has outperformed almost everyone chasing excitement. Here's something most investors hate hearing. Concentration builds wealth, but diversification preserves it. When you're young and have little to lose, concentrating on a few high-conviction investments makes sense. But once you've accumulated significant capital, Jewish strategy says, spread it out. Not for maximum returns, for maximum survival. This means owning different asset classes. Stocks, yes, but also bonds, real estate, maybe some precious metals, maybe a small business, maybe cash. The goal isn't to optimize returns across these categories. The goal is to ensure that no single event can destroy you. When stocks crash, your real estate holds value. When real estate struggles, your bonds provide stability. When everything drops, your cash lets you buy opportunities. My uncle runs a family investment fund. Conservative, diversified, boring. During the 2008 crisis, he lost about 15%. His friends who were concentrated in real estate or stocks lost 50, 60, even 70%. They spent the next decade recovering. He spent it compounding gains. Slower losses during crashes create faster wealth over lifetimes. Let's address the concept of investment horizon, because this dramatically changes how Jewish investors think. Most people invest with short-term thinking. They check their portfolios daily. They get excited by quick gains. They panic during temporary drops. Jewish strategy says, think in decades, not days. When you invest with a 10, 20, or 30-year horizon, short-term volatility becomes irrelevant. You don't care if the market drops 20% this year because you're not selling for 15 years. You actually get excited because now you can buy more at lower prices. Your emotional response to market movements completely inverts. Rachel, someone I know well, started investing at 25. She's 40 now. During that 15 years, she's lived through multiple crashes and corrections. She's never sold anything in panic. She's never checked her portfolio obsessively. She invests monthly regardless of market conditions and ignores the noise. Her returns have been exceptional, not because she picked amazing stocks, but because she didn't sabotage herself with emotional decisions. Here's a principle that seems simple, but most investors violate constantly. Only invest money you won't need for at least 5 years, ideally 10. If there's any chance you'll need the money sooner, it doesn't go into investments. It stays in savings, completely liquid, completely safe. Why? Because markets fluctuate, sometimes violently. If you need to sell during a downturn, you lock in losses. But if you never need to sell, you can wait out any storm. Jewish investors never put themselves in positions where they might be forced to sell at the wrong time. They keep emergency funds. They keep cash reserves. They ensure their investments can stay invested indefinitely. I learned this the hard way. During my first few years investing, I kept my emergency fund too small. When unexpected expenses hit, I had to sell investments to cover them. Sometimes at losses, sometimes missing out on recovery gains. Now I keep 12 months of expenses in cash. My investments never get touched for emergencies. That separation has been worth more than any stock pick. Let's talk about fees, because this is where Jewish investment philosophy gets really particular. Every dollar you pay in fees is a dollar that can't compound. Over decades, fees destroy wealth silently. A 1% annual fee might not sound like much, but over 30 years, it can cost you 30% or more of your final portfolio value. This is why Jewish investors gravitate toward low-cost index funds, not because they're optimal for returns, because they minimize the guaranteed loss from fees. You might not beat the market with index funds, but you won't underperform it either, and you'll keep almost all the gains instead of handing them to fund managers. My father-in-law moved all his investments to index funds 20 years ago. His financially sophisticated friends mocked him. They used active managers, proprietary strategies, exclusive funds. They paid higher fees but expected better returns. 20 years later, his index approach outperformed almost all of them. Not because indexes are magic, because he kept his costs near zero while they paid 2% annually for underperformance. Here's something controversial. Jewish investment strategy avoids leverage almost entirely. No margin trading, no borrowing to invest, no using debt to amplify returns. If you can't buy an investment with cash you actually have, you don't buy it. Why avoid leverage when it can multiply gains? Because it can also multiply losses. And remember, the core principle is, don't lose. Leverage introduces risk that can wipe you out completely. One bad trade with leverage can destroy a lifetime of careful wealth building. It's not worth it. I know an investor named Thomas who used margin aggressively during the bull market. He was crushing it. His leveraged positions were generating incredible returns. He felt like a genius. Then came a sharp correction. His broker made a margin call. He had to sell positions at massive losses to meet it. He lost 7 years of gains in 2 weeks. Leverage giveth, and leverage taketh away violently. Let's discuss business ownership, because this is central to Jewish investment thinking. The best investments aren't abstract financial instruments. They're ownership stakes in real businesses producing real value. Whether that's public stocks, private equity, or your own company, owning productive assets is how wealth gets built. This means preferring stocks over bonds long-term, preferring equity over debt, preferring ownership over lending. Because owners capture upside as businesses grow. Lenders just get their interest. Over long periods, ownership vastly outperforms lending. My grandmother bought stock in 5 companies in 1975. She picked businesses she understood and used. Consumer products, banking, healthcare, energy. Nothing fancy. She never sold. Those investments have multiplied 40 or 50 times. Not because she was brilliant at picking stocks, because she owned pieces of good businesses for 50 years and let compound growth work. Here's the final principle that separates Jewish investors from gamblers. Patience is the actual strategy, not a virtue, not something nice to have. The core strategy. You find good assets. You buy them at reasonable prices. Then you wait. For years. For decades. You let time do the work. Most investors can't do this. They get bored. They chase excitement. They sell winners too early. They panic during drops. They trade constantly. All that activity destroys returns through taxes, fees, and bad timing. Jewish strategy says, do less, wait more. Let compounding work its magic. Warren Buffett, not Jewish but definitely influenced by similar principles, said his favorite holding period is forever. That's the mindset. You're not trading. You're not flipping. You're accumulating ownership in productive assets and holding them while they compound value over decades. So here's what Jewish investment strategy actually looks like. You preserve capital first, grow it second. You only invest in things you understand completely. You diversify for survival. You think in decades. You keep emergency funds separate. You minimize fees ruthlessly. You avoid leverage entirely. You prefer ownership over debt. And you wait patiently while time does the heavy lifting. This won't make you rich overnight. It won't give you exciting stories. But it will almost certainly make you wealthy eventually. And it will do so without the terror of potentially losing everything. That's why Jewish investors rarely lose. Not because they always win. Because they never put themselves in position to lose catastrophically. Tell me in the comments what investment principle you're going to implement first. Hit that like button, because understanding investment strategy changes your financial future forever. Subscribe right now because the next video breaks down the exact asset allocation formula for different life stages. And you need to see where you should be putting your money right now.